stock market rises for more than a decade have been a little bit like this. But it could turn into this. We've witnessed one of the biggest stock market booms from 2009 all the way through until now. So the biggest question is, when's this boom going to end? Well, there's a significant chance that it's already ended and the stock market is entering a new era of lower returns and potential declines. I'm Biko Konstantinos and that's what we're going to talk about today. If you have any interest in the future direction of the stock market, why don't you give this video a like? That will help my content be shared. And please consider subscribing to my channel. I'm passionate about providing valuable content to support you and your investing goals. Now let's get into the stock market. Now the best gauge of the global stock market is the S&P 500, which is an index of the largest 500 stocks in the United States. Looking at the longer term holistic picture, we can see from the early 1980s we had a measured uptrend culminating in a sharp high which ended in the dot-com bubble, and as we know that bubble saw major sell down, which is what we have here. So the market rebounded over many years, and in 2007 the S&P hit a similar level to the dot-com boom, but then the global financial crisis hit and we were sold down again. So for this 10-year period, we really had a volatile, sideways trading pattern over the S&P. However, from the low of the GFC in 2009, it's all been uphill. So we saw a very strong uptrend all the way up until when COVID hit, a short, sharp sell down due to the COVID pandemic, then an almost parabolic rise straight up to around 4,800 over the S&P. One of the great things about studying the price action via the chart is that you get a really good picture of the state of the market, and it can also leave clues. For example, when I look at the weekly chart of the S&P, I can see that from 2009, we had a very orderly uptrend signified by higher highs and higher lows. After the uptrend's been going for a while, we can draw in a trend line to where the price has been coming down to and then rebounding upwards. So you can see this trend line, the price kept rising a bit above and coming back down and rising a bit above and coming back down to that line, which shows that the rate of rise in the uptrend was quite smooth, and if it got a bit above that, it generally came back to that trend line. Now when the price rises way above that trend line, we have to ask ourselves why this might be occurring. And there's two main thoughts that I think of. First, is there a fundamental strengthening of market conditions that would justify such a steep rise? Or second, is there increased speculation which is resulting in prices being overvalued and going up too high too quick? So we can see a great example of this after COVID. The price has shot up extremely fast and now sits miles above the previous rising trend line. So going back to our question, if there has been a fundamental strengthening, it could continue at this rate and you might see a new sharper trend line develop straight up. But one thing to be wary of, things don't generally shoot straight up for continued periods of time. It normally represents market exuberance, greed, overconfidence, speculation, those types of emotions. So if the market has gotten ahead of itself and risen too fast and not really based on the underlying fundamental strength of all the stocks, say in the S&P 500, then you would expect the price to actually drop back down to this previous rising trend line, which currently sits just above 3,000 US. Another great indicator to give us some insights into the market is moving averages. So here on the daily chart of the S&P 500, we have a 50-day moving average represented by the blue line and a longer term 200-day moving average represented by this orange line. Now after COVID, the 50-day moving average crossed above the 200-day and has stayed above this entire time just until recently in March 2022, when it dropped below the 200-day moving average. Now, when this occurs, we do call it a death cross, and it's a bearish signal that is used to forecast the change from an uptrend to a downtrend. Now, this signal can be quite strong because as you can see, when the opposite happened and the 50-day moving average crossed above, the after effects was a long rally. Now, crossovers of these moving averages can potentially lead to a major move because they don't happen too often. So along with the crossover, we can see that the shorter term 50-day moving average has started trending downwards. So this gives us two indicators that all is not well over the S&P 500. Now, just looking at the recent price action over the S&P, we can see the rally continued up to this point where it dropped a little bit but then formed a new high here. And after that rally, we saw quite a quick decline, some buying but not back up to the level of the previous high, then more decline. And most recently, we've tried to rally back up and we've come back to this vicinity, and there has been some resistance at this level, which could be very telling down the track. We're no longer seeing higher highs and higher lows. At this stage, the uptrend lasted until this peak high here, and so far the market's tried to rally twice but hasn't been able to reach a new high. So now I see three main possibilities going forward. First, the market could rally and surge to new highs and the uptrend will resume. Second, we could have some continued sideways trading. Or third, we might actually start to see a downtrend forming where we see lower highs and lower lows. Let's have a look at some of the other US indexes, and I'll just compare with the 50-day moving average and the 200-day moving average. So we've got the Dow Jones with the 50-day moving average clearly breaking below the 200-day. The Nasdaq has actually fallen sharper from its highs, and the Russell 2000 Small Caps Index is actually the weakest of the lot. You can see the 50-day moving average almost crossed below here, and for the second time it has, and is now a long way below the 200-day moving average. The other thing to consider about the Russell is it's not actually too far above the pre-COVID level. All it would need to do is fall down to about 1700 and it's all the way back to pre-COVID, which is a bit of an indicator that all is not well. Let's have a quick look across the globe. We've got the FTSE. It's in an uptrend. However, the price is only at the pre-COVID levels, so it rallied nowhere near as far as the US markets. We've got the DAX, which is the German market. We can see that the 200-day moving average is turned down slightly, and the 50-day moving average is moving down quite sharply. Now, the Shanghai Composite, which is the Chinese market, is in a very strong downtrend. The 200-day moving average is moving down sharply. Also in parallel is the 50-day moving average. And lastly, we have the Nikkei, which is the Japanese market, and it's showing the signs of an early downtrend as well. Overall, global markets are looking bearish, and when I look at those charts, to me there's more probability of declines than there is of restarting in the uptrend. However, as we know, anything can happen in the markets. There's just been a bit of a shift, and it's important to know that and to be prepared. Considering that nearly every market has seen the 50-day moving average cross down below the 200, we may have already seen the peak, and it might be all downhill from here. Now, what about the fundamentals? Is the underlying strength in the economy enough to keep this massive long-term stock market boom going? Well, one reason that I'm very cautious is that the stock market is extremely expensive. The S&P 500 Shiller Cape ratio is at the second highest level it's ever been. The Buffett indicator is extremely high, and the S&P 500 dividend yield is very low. So compared to the long-term median averages, the current stock market is extremely stretched. Now, that doesn't mean it can't go higher. It just means that there's probably a stronger probability that the market will return to the average mean. For more information about these charts and the expense of the stock market, check out this video here. As you would have heard on the news, the Fed has done a major turnaround, has started hiking hiking interest rates and has forecast several more interest rates this year, including potential 50 basis point hikes. So we've entered an environment of extremely high inflation and aggressive interest rate hikes to try and curb that inflation from running away. Now, this is going to have a very large impact on the stock market because the borrowing costs of every business and corporation are going to increase exponentially, and this is going to greatly affect profits, which is most often reflected in a lower stock price. So altogether, we've got weak charts that are looking very bearish. We've got stock market valuations that are extremely expensive compared to their long-term average means. And we've got an environment of aggressive interest rate hikes. So considering all that, we may have actually seen the peak or the high in the stock market. And there's a fairly strong possibility that we've already entered a new bear market, which would see further declines into the future. So what do you think? Do you think we're in for a stock market crash, which is usually characterized by falls of more than 30% from the peak? Or do you think that the long-term boom is going to continue on further? I would love to hear your thoughts. Please let me know what you're thinking in the comments below. I'm Biko Konstantinos. Hey, you might as well subscribe to my channel because the stock market, real estate affects everyone's lives, and I'll be bringing you up-to-date information often. Thanks so much for watching, and I'll catch you in my next video.